Quantitative easing, or QE, is an unconventional monetary policy tool used by central banks, including the Federal Reserve, to stimulate the economy when traditional methods, like lowering interest rates, become less effective, usually when rates are already near zero. QE involves the large-scale purchase of financial assets such as government bonds and mortgage-backed securities to inject liquidity into the financial system. Here's how it works and its effects on the stock market. First, let's talk about how quantitative easing works. Asset purchases. The Fed buys large amounts of long-term government bonds and other securities, like mortgage-backed securities, increasing the demand for these assets. Increasing bank reserves. When the Fed buys these assets, it credits the reserve accounts of commercial banks with newly created money. This increases the amount of money that banks can lend. Lowering interest rates. As demand for bonds increases, their prices rise, and their yields, or interest rates, fall. This leads to lower long-term interest rates, even if short-term rates are already near zero. Boosting asset prices. The Fed's asset purchases flood the financial system with liquidity, driving down borrowing costs for businesses and consumers, which encourages investment and spending. Now, let's look at the effects of QE on the stock market. Increased liquidity. QE injects massive amounts of money into the financial system. With more liquidity in the market, investors tend to shift their funds into riskier assets, like stocks, in search of higher returns. This drives stock prices higher. Lower interest rates. By pushing down long-term interest rates, QE makes borrowing cheaper for corporations. This can increase corporate profits and lead to higher stock valuations. Additionally, lower rates make fixed income investments, like bonds, less attractive, prompting investors to turn to stocks for better returns. Wealth effect. Rising stock prices during QE can create a wealth effect. As the value of portfolios increases, investors feel wealthier and are more likely to spend, which further stimulates the economy. This also improves consumer confidence and demand, supporting business earnings. Devaluation of the dollar. QE often leads to a weaker dollar because the increase in money supply reduces its value relative to other currencies. A weaker dollar can benefit U.S. exporters, as their goods become cheaper for foreign buyers, potentially boosting corporate earnings for multinational companies. Risk-on sentiment. QE fosters a risk-on environment, where investors are more willing to take risks in search of higher yields. This generally benefits riskier assets like equities, especially growth stocks, technology, and speculative sectors. Finally, let's discuss stock market trends. During QE, bull markets. Historically, stock markets tend to rally during periods of QE. As liquidity floods the market, stock prices rise due to increased demand, low interest rate environments, and improved investor sentiment. Valuation expansion. Low interest rates and easy monetary policy reduce the discount rate used in valuing stocks, often leading to higher price-to-earnings ratios. Investors are willing to pay more for future earnings when interest rates are low. Sector-specific impact. Certain sectors benefit more from QE, including technology, where lower borrowing costs support high-growth tech companies with significant capital needs. Consumer discretionary. Easier credit conditions encourage consumer spending on non-essential goods, benefiting consumer-focused companies. Financials. Banks may benefit from easier lending conditions, though very low interest rates can sometimes squeeze profit margins. Risks and potential negative effects. Inflation. A prolonged quantitative easing can increase the money supply too much, leading to inflation if the increased liquidity is not matched by corresponding economic growth. High inflation can erode purchasing power, hurt corporate profits, and eventually lead to a stock market correction if the Federal Reserve is forced to raise interest rates. Asset bubbles. Quantitative easing can create asset bubbles in financial markets. Excess liquidity can lead to inflated stock prices, with valuations potentially disconnecting from underlying corporate fundamentals. If investors perceive that stocks are overvalued, a sharp correction or crash can follow. Diminishing returns. Over time, quantitative easing's effectiveness in stimulating the economy can diminish. As interest rates near zero or even negative, central banks may have fewer tools to combat economic downturns. Investors may become overly dependent on monetary stimulus, creating volatility when quantitative easing is tapered or ended. Tapering risks. When the Federal Reserve signals the end of quantitative easing or begins to reduce its asset purchases, a process called tapering, markets may react negatively. In 2013, when the Federal Reserve hinted at tapering its bond purchases, the stock market experienced the taper tantrum, a brief but sharp sell-off. Historical examples of quantitative easing: 2008-2014 global financial crisis. In response to the global financial crisis, the Federal Reserve initiated several rounds of quantitative easing to stabilize financial markets and stimulate the economy. Stock markets eventually rebound after the initial crash, with quantitative easing helping fuel a long-term bull market. 2020 COVID-19 pandemic. During the COVID-19 crisis, the Federal Reserve launched an unprecedented round of quantitative easing, purchasing trillions of dollars in bonds and other securities. This helped prevent a deeper economic crisis and sparked a strong stock market recovery after the sharp drop in early 2020. Conclusion: quantitative easing is a powerful monetary tool that can have a significant impact on stock markets by lowering interest rates, increasing liquidity, and driving up asset prices. While quantitative easing often boosts stock markets in the short term by encouraging risk-taking and investment, it can also lead to risks like inflation, asset bubbles, and market volatility when the policy is withdrawn. Investors need to be mindful of these dynamics when considering the long-term effects of quantitative easing on their portfolios. Spotting the early signs of quantitative easing, or QE, by the Federal Reserve can help traders position themselves to capitalize on the effects of such policy measures. While QE is usually announced in response to economic distress or slowing growth, here are some key indicators and signals to watch, for that can suggest QE may be on the horizon. 1. Economic indicators. Showing slow growth or recession risk. The Federal Reserve usually resorts to QE when the economy is showing signs of severe slowdown or recession, and traditional monetary tools, like lowering interest rates, are insufficient. Look for rising unemployment. A persistent rise in unemployment is one of the strongest indicators of economic trouble. If jobless claims increase steadily, the Fed may intervene to stimulate the economy. Falling GDP growth. Sluggish or negative GDP growth signals economic contraction. When growth stalls or shrinks over multiple quarters, the Fed is more likely to consider QE to spur economic activity. Low inflation or deflation. QE is often used when inflation is too low or there's a risk of deflation, which can hinder economic growth. A drop in inflation or a risk of falling prices may prompt the Fed to introduce QE to boost demand. 2. Signals from the Federal Reserve, Fed speeches and statements. Pay close attention to speeches by Federal Reserve officials, especially the Fed chair, and statements from the Federal Open Market Committee, or FOMC, meetings. If they discuss concerns about economic weakness, low inflation, or market instability, they might hint at upcoming QE. Watch for terms like unconventional measures or discussions about non-standard monetary policy tools. This often signals that interest rate cuts alone may not be enough, and QE could be on the table. Minutes of FOMC meetings. After each FOMC meeting, the Fed releases minutes that detail the discussions held by the central bank's policymakers. If the minutes indicate a rising concern about economic stability or ongoing financial market stress, it may be a sign the Fed is contemplating QE. Bond market behavior. Falling long-term yields before quantitative easing. Investors often anticipate QE before it's announced, and one of the signs is falling yields on long-term U.S. Treasury bonds. As QE is expected to drive demand for these bonds, investors may start buying bonds, pushing prices up and yields down in anticipation of the Fed's purchases. If long-term yields are dropping significantly, it could signal that the market is expecting the Fed to step in with asset purchases. Curve, flattening, or inverting. A flattening or inverted yield curve, where short-term interest rates are close to or higher than long-term rates, often signals economic trouble. This increases the likelihood of QE, as the Fed may intervene to push down long-term rates and steepen the yield curve to support borrowing and lending. Market volatility and risk-off sentiment, stock market decline. If stock markets experience prolonged declines or increased volatility, it may prompt the Fed to step in with QE to stabilize financial markets. Large sell-offs, particularly in major indices like the S&P 500, combined with a flight to safe haven assets like treasuries, could be an early indicator of potential QE. Widening credit spreads. If the difference between corporate bond yields and government bond yields, or credit spreads, widens significantly, it shows increasing risk aversion in the markets. This often signals financial distress and could push the Fed toward QE to calm markets. Low or negative interest rates. Interest rates near zero. When short-term interest rates approach zero, or even go negative as seen in other countries, it limits the Fed's ability to stimulate the economy through traditional rate cuts. This is often the point at which QE becomes more likely as the Fed turns to asset purchases to further ease monetary conditions. Deterioration in global economic conditions. If global economic conditions deteriorate, such as during the 2008 financial crisis or the 2020 COVID-19 pandemic, the Fed may initiate QE to prevent contagion in U.S. markets. Pay attention to global trade data, slowing growth in major economies like China, or geopolitical risks that could impact the global economy. If other major central banks like the European Central Bank or Bank of Japan begin implementing QE, the Fed may feel pressured to follow suit, particularly if their actions result in a stronger U.S. dollar, which could hurt U.S. exports. Low bank lending and credit tightening. Tightening credit conditions. If banks are reluctant to lend, it signals financial stress in the system. The Fed may use QE to increase liquidity and encourage more lending. Look for signs of a slowdown in bank lending, such as declining loan growth or rising interbank lending rates, which suggest tightening credit conditions. Large-scale Treasury issuance. Government bond issuance. If the government is issuing a large amount of new debt, especially in response to an economic crisis or fiscal stimulus packages, the Fed may initiate QE to help absorb this new debt. Watch for announcements of increased Treasury auctions or stimulus bills, as they could precede QE to support demand for bonds. Market expectations and speculation. Watch analysts and economists. Market analysts and economists often speculate about QE based on Fed signals, economic conditions, and market behavior. Following major financial institutions, investment banks, or economists can provide insights into whether QE is likely to be introduced. Fed Fund Futures. Traders also keep an eye on Fed Fund Futures contracts, which reflect market expectations about the direction of Fed policy. If futures show expectations of prolonged low interest rates and concerns about growth, QE may be more likely. How to capitalize on QE in trading. Buy stocks, especially growth stocks. QE tends to drive stock prices higher, particularly in growth sectors like technology, which benefit from low borrowing costs and increased liquidity. Shift to risk-on assets. QE creates a risk-on environment where investors move into higher-yielding assets like stocks, high-yield bonds, and real estate. Traders can capitalize by moving out of safe haven assets and into equities or other riskier markets. Trade ETFs. During QE, broad-based stock indices like the S&P 500 and NASDAQ usually perform well. Consider trading ETFs like SPY, S&P 500, or QQQ, NASDAQ 100, to capture market-wide gains from QE. Buy bonds before QE starts. Anticipating QE can allow traders to buy long-term bonds before the Fed steps in, benefiting from price appreciation as QE pushes bond prices higher and yields lower. Use call options. If you expect a stock market rally due to upcoming QE, call options on stocks or indices can be a leveraged way to capitalize on price increases while limiting your risk. Trade gold and commodities. QE typically weakens the US dollar, which can push up commodity prices like gold and silver. Traders can buy gold ETFs or futures contracts to benefit from rising prices. By paying close attention to these economic and market signals, traders can anticipate the potential for QE and position themselves accordingly to take advantage of its impact on stocks, bonds, and other financial markets.